Good morning and welcome to the Post-Monetary Policy Committee press briefing. The Monetary Policy Committee of the Central Bank met yesterday, the 5th of June 2024. And today, as is usual, the Governor will take us through the presentation from the Monetary Policy Committee and will also be able to take questions. As usual, please send in your questions through Slido. That is www.slido.com. The meeting code is MPC 0624. And now I'd like to invite and welcome the Governor of the Central Bank of Kenya, who's also the Chairman of the Monetary Policy Committee, Dr. Kamau Thugge.
Good morning. Sorry for the late start. During its meeting on June 5th, 2024, the Monetary Policy Committee retained the central bank rate, the CBR, at 13%. The MPC noted that, one, its previous measures have lowered overall inflation to 5.1%, stabilized the exchange rate, and also anchored inflationary expectations. Second, the non-food, non-fuel inflation has remained sticky in the recent months. And third, that interest rates in the major economies are expected to remain higher for longer due to the stickiness of their inflation rates. The MPC therefore concluded that the current monetary policy stance will ensure that overall inflation remains stable around the midpoint of the target range in the near term, while ensuring continued stability in the exchange rate. The MPC will closely monitor the impact of this policy measure, as well as the developments in the global and domestic economy, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in August of 2024. So in making that decision, the committee looked at both the global as well as domestic developments. In regard to the global developments, global inflation has moderated, but some stickiness has persisted in the advanced economies. The IMF April 2024 WEO projections indicate that global inflation will decline from 6.8% in 2023 to 5.9% in 2024, mainly reflecting the impact of the tight monetary policies and also lower commodity prices. So for the global inflation, headline inflation rates, especially in the major economies, have generally been easing, but that pace of the decline has been below expectations, and especially with some stickiness in the area of core inflation. For example, in the case of the US, looking at the chart or the slide on your left, you can see, broadly speaking, that there hasn't been very much of a big change between, let's say, around October of 2023 and the current headline inflation of 3.4. And similarly, on the right-hand slide, the core inflation has broadly, it's now 3.6, it went to 3.6 in May from 3.8, but has been quite sticky. With regard to international fuel prices, these have also moderated, and this is due to the reduced risk premium from the Middle East conflict and improved supply by non-OPEC plus oil producers. The oil prices are expected to decline on average in 2024 relative to 2023, mainly driven by weak demand, particularly in China, and also stronger non-OPEC plus supply. And during the meeting on June 2nd, 2024, the OPEC plus oil producers have signaled the intention to start increasing production from the fourth quarter of 2024. In regard to global commodity prices, food inflation has continued to decline, with the improved supply of key food items, particularly sugar and cereals. And you can see there that global food inflation as of around April was minus 7.4, and so therefore this has contributed to the decline in the overall global inflation. Turning now to the global economic developments, the global growth is projected to be at 3.2%, which is the same growth it recorded in 2023. And it's also projected that growth will remain around 3.2% even in 2025. Maybe of particular interest is the strong growth in the United States, which is expected to have an acceleration in growth from 2.5 to 2.7 this year, but also to moderate somewhat in 2025 to about 1.9%. Again, of particular note is the developments in the Eurozone area. And in 2023, there was virtually no growth at 0.4. We expect some recovery this year, although it will still be less than 1%. And then some further recovery in 2025 to 1.5. And again, maybe of particular mention is Germany, whose economy contracted by minus 0.3 last year, and is only expected to recover to 0.2% in 2024, before a larger recovery in 2025. In regard to the emerging market and developing economies, we see a fairly steady growth of around 4.2% this year, as well as next year. And that is driven mainly by very strong growth in the Indian economy of 6.8% this year, followed by 6.5% in the 2025. And similarly, we also see the China economy growing by 4.6% this year and 4.1%. We did note that there was very strong growth in China in the first quarter of this year, and possibly the 4.6% projection for 2024 is likely to be adjusted upwards. In regard to sub-Saharan Africa, we see an increase in growth prospects from 3.4 in 2023 to 3.8 this year, and a further increase to 4% next year. Again, just comparing the growth of Kenya versus the rest of the world, we do see that in 2023, growth was 5.6 for Kenya, compared to 3.4 for the sub-Saharan Africa, 4.3 for the emerging markets and developing economies, and for global growth of 3.2%. Again, this pattern repeats in 2024 and 2025, where we expect growth of the Kenyan economy to be well above the other areas of the world. Looking at the global financial markets, the conditions have improved, and this has reflected equity market performance driven by improved investor optimism about the global growth. And on the left, you can see that equity performance in advanced and emerging market economies have generally trended up since around October of 2023. And on the right are the performance of selected stock indices. And again, there you can see generally an upward trend, perhaps with the exception of China, which has been experiencing some difficulties, or at least not growing as much as it has been growing in the past, partly due to some problems in the real estate sector. But important to note here is also the MSCI, which is the Morgan Stanley Capital International Emerging Market Index, and also the FTSE Russell 2000, which also have been doing fairly well, and where we have, I think because of the the deepening of our interbank foreign exchange market earlier this year, they have also decided to include some of our companies in their indices, and this is a very good sign for the stock market here, but also it could mean that we get additional foreign exchange inflows of foreign investors investing in our companies. So emerging markets and developing economies have continued to issue international bonds given the favorable market conditions and also the narrowing of the sovereign borrowing spreads. On the right, you can see that the spreads for Kenya for the sovereign bonds that are trading, these spreads have continued to decline, and we do expect that this narrowing of spreads will continue. Turning to the domestic economy and starting with the inflation, as I said, inflation has been decelerating, and in April reached our target range of 5%. In May, there was a slight acceleration to 5.1, and that essentially came from an increase in food prices, and food inflation did increase from 5.6 to 6.2, and shortly we'll see the main reasons for that increase. But that increase in food inflation was broadly offset by the reduction in fuel inflation from 8.3 to 7.8%, and similar, and also because of the reduction in non-fuel inflation from 3.6 to 3.4. So those two reductions broadly offset the increase in food inflation. In terms of the contribution to inflation, we can see at the end of May, and maybe compared to April, non-food, non-fuel basically still contributing to about 1 percentage point of inflation. Fuel, similarly about 1.8, 1.8, that has not changed very much. And here you can see that really the main contributor to the higher inflation was food. On the non-food, non-fuel, there has been, I think as the monetary policy continues to be felt in the economy, there has been a reduction in inflation from 3.6 to 3.4 in May. And but again, you can see the stickiness of the core inflation since around December 2023. It's just been fluctuating between 3.4 and 3.6. Turning now to the main drivers of food inflation. Again, you can see just at the very end where food inflation has increased to 6.2, that the drivers of that inflation is vegetables, which increased from 3.2 to 5.1. But otherwise, the non-vegetable inflation has continued to decelerate from 2.4 to 1.1. So just looking at in more details on what's driving the food inflation and specifically the vegetables inflation, which reached 25.6% in May. Really, the main contributors are onions prices. You can see that in the green part. Tomatoes also. In fact, the prices of onions rose by 67.7% in May 2024, and therefore contributed to about 0.4 percentage points of the overall inflation. This is compared to 0.5 percentage points in the previous month. With regard to tomatoes, their prices increased by 29.7% in May 2024, and also contributed to about 0.4 percentage points to overall inflation. In contrast to the vegetable inflation, non-vegetable inflation has continued to be negative, and we're looking at items such as maize, wheat, milk, and edible oils. And that negative inflation has continued to accelerate, and in May, in terms of its contribution to overall inflation, reduced overall inflation by minus 0.7. Also of a particular note is the sugar price inflation, which at some point in mid-2023, inflation was at almost 64%, but we have now seen that price of sugar decelerate, and now on May 2024, that price was 11.1% lower than the price in May of 2023. Turning to fuel inflation, again, there was a deceleration from 8.3 in April to 7.8. And really the main factors behind this was pump prices decelerated. Transport costs also declined. You can see their contribution from 4.7 to 4.4. And other items also declined from 2% to 1.9. The only area of increase was in electricity prices, where we have an increase from minus 0.1 to 0.5. But I'm made aware that the KNBS and the KPLC are also looking into the numbers behind the inflation of prices of electricity. So in terms of looking forward and expectations, we did have a survey in the agricultural sector, and the results of this survey show that about 57% of the respondents expect inflation to remain either unchanged or to decline. But there is 43% who expect inflation to increase, just basically concerned about the recent weather conditions and the flooding that took place. But in general, although the number of respondents, the percentage of respondents compared to March has declined, of those expecting inflation to decline and to remain unchanged, we still have a huge majority of the respondents in May expecting inflation to remain unchanged or even to decline further within the next 3 months. Turning to the domestic economy, despite the recent flooding in some parts of the country, the economy is expected to remain strong in 2024, supported by the resilient services sector and robust performance of the agricultural sector, and continued implementation of government measures to boost economic activity across the government's priority sectors. So for agriculture, we just got this information from the economic survey that was just launched a few weeks ago. And you can see that for 2023, that the annual growth, real GDP growth, turned out at 5.6, which is exactly what the central bank had been projecting all the way back from July, August of 2023. So our projection of 5.6 came out exactly right. And this 5.6 reflects a very strong performance in the agricultural sector of 6.5. This is one of the largest increases in value addition in agriculture we have seen for almost 15 years. It was also supported by very strong performances in services, and there I would highlight the financial and insurance sector, which increased by 10%. I would also highlight information and communication, which increased by 9.3%. And of course, there's accommodation and food services, which increased by almost 34%. And finally, also highlight the real estate sector, which grew by 7.3%. And I highlight those because their share of GDP is quite significant. And so when they perform well, the overall GDP also performs well. And equally, I'd like to just point out some of the where the economy didn't do so well. And that was the wholesale and retail trade. We only had a growth of 2.7. This is well below what has the growth in the recent past. Construction was also low and only recorded 3% compared to fairly large increases in the past few years. And of course, finally, is the challenging area of manufacturing, which only recorded a growth of 2%. So, and going forward, we have projected a continued momentum in agricultural performance with the projection of 5.1%. The industry sector will recover somewhat, but I think there is still scope for a significant increase in the industry sector. And of course, the services sector, we expect the momentum, that resilience to continue, perhaps at a lower pace compared to last year. And so we are projecting an increase in services of 6.6% compared to 7% last year. In terms of the credit to the private sector, we have seen there are two lines here. One is the overall current credit growth, which shows a deceleration in credit to the private sector from 13.8 to 6.6 in April. That deceleration from 13.8 to 6.6 to a large extent reflects the appreciation of the exchange rate and the impact it had on the dollar-denominated credit. And if we factor in or make an adjustment for the exchange rate appreciation, the growth in credit to the private sector broadly it has declined between March. You can see it was in March it was 9.1 to 8.1, but the decline is not as dramatic as when you include the impact of the exchange rate on the dollar-denominated credit. Turning to the balance of payments, we do expect the current account to remain broadly unchanged in terms of GDP, but in terms of dollars, we expect it to widen somewhat from the roughly $4.3 billion to about $4.8 billion. We do expect, and I'll come back to this later, we expect overall exports to increase by anywhere between around 11%. We expect goods imports to recover and to increase from $17.2 billion to about $18.8 billion. The services sector, there are some challenges, especially on services credit, but essentially we do expect the secondary income, particularly remittances, to perform very well this year. And as I said, the combination of an improvement in the trade balance, an improvement in the secondary balance, we should be able to offset some weakening in the services balance as well as in the primary balance. And so overall, the current account should remain at 4% of GDP this year. That current account deficit of 4.8 should be able to be funded by a capital account of 134 million, the financial account of 3.2 billion. In the financial account, we include foreign direct investments, but we also include inflows, and any borrowing by the government would be included in here. So after taking all that into account, including the disbursements from the IMF, the very last line, you can see a disbursement from the IMF of $1.555 billion. We should see an increase in deposits of the international deposits of the central bank by roughly $62 million. I already mentioned this is the current account deficit. You can see that it has been narrowing from 2022. It was 5.1% of GDP. It narrowed to 4% in 2023. And this was driven mainly by the improvement in the trade balance and also in the secondary services, particularly remittances. And as I said, in 2024, we expect the current account to remain at 4% of GDP, again due to better performance in the trade balance, and also better performance in the secondary income. Looking at the exports of goods, you can see that in 2023, actually exports declined by 2.6%. We've already started to see a recovery in exports. The 12-month exports through April compared to the same period in 2023, we already see an increase in exports by 2.9%. But if you just take the first 4 months of this year and compare with the first 4 months of last year, we see a significant improvement in exports of 15.2%. This is just a detail of what is driving the growth of exports, and that growth of exports is coming from the tea exports, both because of higher prices. You can see the higher prices in 2024 are much higher than they were in 2021, 2022, and also 2023. And then on the right panel, you can see actually that the volume of quantities of tea sold at the Mombasa auction has been higher this year than it was last year. So you have a combination of higher prices and higher volumes, which is driving an improvement in tea exports, and we do see a significant, almost by 20% increase in tea, from essentially 432 million in January to April of 2023 to 520 million in January-April of 2024. Also exports of horticulture, we've seen a significant improvement, and just looking at at actually both the volumes as well as the values. The top looks at the exports of in terms of volumes and tons, and there you can see from January to April that in 2023 the volume was 189,000 tons, and in 2024 that has increased to 246,000 tons. And just below that is the increase or is the values in terms of US dollars. And again, there's an increase in the first 4 months from 315 to 363 for this calendar year. Turning now to imports, as I said earlier, in 2023, we saw a significant drop in imports for various reasons, and that was about 11%. We have started to see a recovery in imports this year, and in the first 4 months of this year, we have seen imports valued at $5.9 billion compared to $5.8 billion last year, and this is an increase of 2.2%. For the whole year, we do expect imports to recover. We do expect intermediate imports to recover, capital as well as consumer imports. This is just a detail of goods imported, and maybe just to point, at least for the first 4 months, that what has been driving the growth of imports is really machinery and transport equipment, and in particular the industrial machines, which have increased quite significantly, and also other transport equipment, particularly related to the railway. Diaspora remittances continue to perform very well, and in 2023 recorded a 4% increase. In the first 4 months of this year, we have seen a significant improvement over last year of 20%, and we expect this to continue. We have revised our projections for remittances from the previous 5%, and although so far remittances have grown by 20%, we have been fairly cautious, and in our balance of payments, we have assumed an increase in remittances of only 12%. So there's likely a possibility of overperformance in the current account if indeed we can get remittances to grow by to 20%. This is showing where the remittances are coming from. Of course, the United States continues to be the main source of remittances, but as you can see, remittances are coming from many countries, and so to that extent they are resilient, and so when one country does not perform, other countries perform, and so that's why we've been able to sustain an increase in remittances despite when there's a slowdown in global economic growth. There's a number of tourist arrivals. The bottom line there you can see is that for the 12 months up to March, tourism arrivals have increased by 27.2%. And again, just to emphasize that the tourism sector continues to perform extremely well. I look at the exchange rate developments. The shilling has strengthened in 2024, and this strengthening reflects increased inflows of foreign exchange, the impact of the monetary policy measures, tightening that we have, the central bank has undertaken, the impact of the recent reforms in the foreign exchange market, and the buyback of the June 2024 Eurobond that we did in February. But essentially, the panel on the left is comparing the performance of the Kenyan shilling vis-a-vis globally, and you can see that the Kenyan shilling has performed better than virtually all the other currencies. It has appreciated against the US dollar, appreciation meaning has strengthened against the US dollar by about 17%. And when we look closer at home and look at the performance of other currencies in the region, you can see that still we have a very strong performance, followed by the Botswana pula, and then just of note is the weakening in the Egyptian pound as well as the Nigerian naira, which had strengthened at some point, but has displayed some weaknesses in the past few weeks. So in terms of the central bank's usable foreign exchange, as of June 4th, it was 6.979, which is equivalent to 3.63, and we consider this amount to be adequate to meet any short-term shocks or any emergencies that are not foreseen. And of course, having a flexible exchange rate system also essentially translates to 3.63 months of import cover, as well over the 3%, the 3 months of import cover that is normally suggested even by the IMF. So on fiscal performance, the government still remains committed to fiscal consolidation. The supplementary budget has just been approved by Parliament. It has a deficit of 5.6%. The Treasury has submitted a budget to Parliament for 24-25, and the target there is to reduce the fiscal deficit to 2.9%, and over the medium term to retain the overall fiscal deficit at around 3%, and this is consistent with stabilizing the debt and also moving towards the debt target, debt anchor of 55% of the net present value of debt to GDP, which is expected to be reached around fiscal year 28-29. So just quickly on the implementation, we have a new monetary policy implementation framework. So in the discussion, the MPC noted that the new monetary policy implementation framework that was adopted on August 9th, 2023, has resulted in improved functioning of the interbank market. It has also narrowed the interest rate spreads and with reduced market segmentation and improved monetary policy transmission. To enhance the effectiveness of the monetary policy implementation framework, the MPC considered and approved a recommendation to review the width of the interest rate corridor around the central bank rate from the current 250 basis points to 150 basis points. And in line with this review, the MPC also approved a recommendation to adjust the applicable interest rate on discount window from the current 400 basis points above the CBR to only 300 basis points. So this is what it would look like. We have the blue line is the CBR. The current framework has 2.5 percentage points above and below. So currently, since the CBR is at 13%, and at the current framework, the top part of the corridor is now about 15.5, and below that will be about 11.5. The proposal is to narrow that so that the top part would be 14.5 rather than 15.5, and also raise the bottom part. And we believe that moving in this direction will improve the effectiveness of monetary policy and make the transmission of the changes of policy by the Monetary Policy Committee transmit quicker and more effectively to the economy. Thank you very much.
Thank you. That was the governor, who's also the chairman of the Monetary Policy Committee. We now want to go straight into your questions. And as a reminder, if you want to send any questions, please do so through Slido, hashtag MPC0624. We begin with Herald Alo from the Africa Report. Herald Alo is asking, with the inflows from the World Bank and the IMF, how do you project Kenya shilling fluctuations? Do you foresee settlement of the remaining Eurobond portion significantly impacting the Kenya shilling? Stella Swake is asking a similar question with regard to the level of the shilling. Is the shilling's equilibrium between 130 and 135 against the US dollar, given that the unit has been oscillating within that range for some time now? Jimmy Mbogo from Citizen Television, what is CBK's view of the recent proposal in the Finance Bill 2024 and its projected impacts to the financial sector? Rama Nyang asks a similar question. Rama is from CGT and Africa. From CBK's perspective, will the proposed taxes on financial transaction fees and increases in excise duty reverse gains in financial inclusion and mobile money use?
Okay, let me start with Mr. Alo and his question on the inflows from the World Bank and IMF and the fluctuations in the exchange rate, and whether I see the settlement of the remaining Eurobond, the 500 Eurobond that is falling due on 24th of this month, whether that will have an impact on the on the exchange rate. I think, by the way, just for purposes of information, I think the World Bank board did meet, I think it was last week, and we do expect some disbursements from the World Bank of about $1.2 billion related to the development policy operations. Part of that disbursements will be used to settle the $500 million of the remaining Eurobond. I think just again to repeat on the issue of the exchange rate, our exchange rate is determined by market forces. It has recently the inflows of foreign exchange have been somewhat higher than the demand, and so we expect going forward a fairly stable exchange rate. We don't see significant weakening or significant strengthening. I think there should be stability now in the exchange rate. I think Ms. Stella Swake, I think it's basically the same question about the equilibrium shilling exchange rate. This will be market and will continue to be market determined. We will intervene when we need to if there is excessive volatility on either side, but we will let the market determine. We'll see how the balance, the current account performs. We'll see how the capital account and the financial account perform, and it's the interaction, the inflows and outflows of foreign exchange through the balance of payments that will ultimately determine the level of the exchange rate. These proposals in the finance bill and their impact on the financial sector and financial sector inclusion, I would rather wait and see what actually comes out of Parliament before commenting on this. But I would want to comment more generally about the fiscal consolidation. That's one of the areas that I covered in my presentation. And really, it's really important for us to achieve that fiscal consolidation. And when I look at the non-discretionary expenditures in our budget, and by those I mean the debt service that is falling due, the salaries, and of course the disbursement to county governments, and maybe even some of the expenditures in the education sector, the free primary education, the free secondary and the junior secondary school. Those expenditures virtually exhaust all the ordinary revenue that we will be collecting next year. And so it begs the question, if all the ordinary revenue is exhausted by those non-discretionary expenditures, which can't be cut, then it does mean that in order for us to stabilize our debt, that we would have to generate more resources. And by more resources, I don't mean borrowing, because already we have all agreed that our debt levels are high. So we want to avoid as much as possible borrowing more. And if we can't borrow more, then we will really need to generate our own resources. And so I make that more as a general statement, and to support really the need for domestic mobilization of resources, basically to be able to run government, to be able to invest in infrastructure, and equally important, to arrest the growth in debt.
The second set of questions will begin with Ramanyang from CGTN again, with inflation and the Kenya shilling stable, as well as real interest rates around 8%. What's the argument from the MPC's view to not start a gradual reduction in the CBR? Ronaldo D'Souza from Sterling Capital asks a similar question. Is there a chance that we will see a downward revision of the CBR before benchmark rates in Europe and the US are revised? Again, two sets of similar questions. First, from Brian Guge of the Standard newspaper, could you please provide details on the timelines for the second Eurobond buyback schedule for 2024, with the aim of reaching a total of $2.5 billion for the year? David Habling from Bloomberg News, what's your take on Kenya's plan to buy back the $1 billion bullet bond maturing in 2028? And a final one on a different subject, Ken Abuya from Tech Cabal, what's the status of Flutterwave, Cheaper Cash, Remex and Candon license application, and are these authorized to operate in Kenya?
Yeah, let me start with Rama Yang questions on the inflation having reached our target and the shilling being stable, and the argument for the MPC not to reduce rates. I do agree with Rama that real interest rates are on the high side. And of course that was the intention if we are going to deal with the inflationary pressures that we are experiencing, and also the exchange rate pressures that we were experiencing. It was necessary that we raise the real interest rate. The question, I think, going forward, and I think this also covers Mr. D'Souza's question, is at what point do we start lowering the CBR? And I think the decision that the MPC took, as I said, took into account global developments. And from what we see at the global level is that inflation rates have been quite sticky. And you only have to look at the US and you see that for quite some time they have not been able to, it's only now that they've been able to go below the 3.5% inflation. Now it's 3.4. So there's some stickiness, and because there's that stickiness in inflation coming down, they have also delayed the reduction in their policy rates. And so the expectation is that international interest rates will remain higher for a much longer time than we had anticipated. And we have to be very cautious that we don't take measures here that will cause the same kind of problem that we had last year, which is, again, to widen the interest rate differentials between Kenya and those advanced economies, whereby we again see capital flowing out because our return is lower than abroad. That starts to put pressure on the exchange rate. The pressures on the exchange rate start to put pressure on imported inflation, on fuel inflation. And so we go back to the situation where we were with a depreciating exchange rate and higher inflation. And again, when we get to that point, we go back to, again, having to raise interest rates to address those inflationary pressures and to address those pressures on the exchange rate. So we are going to be cautious. We'll have to look at developments externally, and really on the basis of that, then we will be able to address the CBR at the appropriate time. Having said that, I think there's still scope for the interest rates on treasury bills and bonds to adjust, even without the adjustment of the CBR. I think the fiscal position and the measures that have been submitted to Parliament designed to lower the deficit to the 2.9% of GDP. Were we to be able to achieve that fiscal deficit, it will reduce significantly the government domestic borrowing, and that would really push down interest rates, the treasury bill rates. And so again, just to urge that we move forward in that direction. If we can't reduce government domestic borrowing, then it will be very difficult to lower interest rates. I think on the issue of the second year, the buyback, that we'll have to have discussions with the Treasury to see what it is that they are planning. I don't have details on that, but that's a conversation we can have with the National Treasury. On the payment service providers, PSPs, we are of course in the process of updating and amending and basically coming up with a new Payments Act. We hope to be able to finish that soon, and also the regulations, and that will really guide our way forward in terms of the payment service providers space.
Final set of questions. We begin with Kefa Moirore. Kefa is from the Business Daily. Kefa is asking, how soon would CBK expect revisions on the interest rate corridor / discount window to impact commercial bank lending rates, and what was the impact previously? Stella Swakei from Standard Investment Bank, is there an update on the proposed upward revision of core capital requirements for banks? George Obulutsa from Reuters News, who asks, barring the flooding earlier this year, did the central bank have a different GDP growth forecast for 2024? Finally, from Collins, who calls himself a Mwananchi wa Kawaida, he says banks and mobile money companies take too much of our info. Is this data protected? And he lists the KRA, ID, contact info, personal info, and fingerprint. Is citizen privacy important?
I think on Moirore's question on whether the revision on the interest rate corridor would have an impact on commercial bank lending rates. No, it should not. This is just a refinement of the current framework, just to be able to make it more effective and for the transmission to be much more direct. The policy that the MPC has taken is to retain the CBR at 13%. That is neutral in the sense that it does not mean that we're going to loosen or tighten monetary policy either way. So it shouldn't have the framework itself. Just the framework itself should not have any impact on commercial bank lending rates. Those will be impacted at the time when we change the CBR either up or down. I think on the second question, on the upward revision of core capital requirements for banks, that is still on the table. We are discussing with Parliament. The Finance Committee has been informed about it, and I'm sure more information will come out, and there will be public participation on this particular area. There's a question on barring the flooding earlier this year, did the bank have a different GDP growth forecast for 2024? No, we have had a growth of 5.7 for the year as a whole. We did have, just using the leading economic indicators, we did have a projection of 5.8% in the first quarter. We have, as I said earlier, we did have an agricultural survey and asked those people who had been affected by the floods. Or I think, if I recall, about 61% of the people we surveyed said they had been affected, that is in the agricultural sector, had been affected by the flood. But we also asked them to what extent they had been affected and how much of their produce was affected. And about only 25% of their production had been, less than 25% of their production had been affected. So yes, we did have a projection of 5.7 before, and we have seen no reason to change that projection up to date. I think on the Mr. Collins, on this data protection, I think probably this is a question better directed at the Commissioner on data protection. Yeah, I think that would be the best place to direct that question.
All right, thank you. And that brings us to the end of this month's post-MPC press briefing. This was held, as we said, after the Monetary Policy Committee meeting of June 2024. And as usually announced, we expect the next Monetary Policy Committee meeting to be in the month of August. So we hope to see you post that. But as the press release says, in case there's any need for the MPC to meet earlier, we will let you know. But for now, thank you very much for being with us, and do have yourselves a good day.